It's a case study of a company called AgFeed. It's still in process, actually. It's still pending in the bankruptcy court in Delaware. We're going to be talking primarily of events that have taken place primarily in 2013 and carrying over to today as well. And I know each of you in this room, working in the distressed investment context, are active in situations that require immediate attention and the resolution of many issues, all on a contemporaneous basis. I think you'll find also that whoever the script writer was for AgFeed, I'm not quite sure they left a whole lot out in terms of the types of issues that have and do continue to confront the company itself. So what I'd like to do is introduce our panelists, and then I'm going to give a bit of a brief history of AgFeed, and that will set the context for the discussion and hopefully for your questions as well. Keith Maib is a senior managing partner of Mackinac, the financial advisory firm. He heads, among other areas, the restructuring area. I notice also that you've now added to Mackinac a whole section now on data intelligence as well. So Mackinac continues to expand its platform. Keith has acted as Chief Restructuring Officer, CEO on an interim basis of many companies that have gone through a process similar to that of AgFeed. In a prior life, he was a partner at 2 international accounting firms, skills that really came into huge play here in AgFeed as well, besides his operational and strategic focus also. Euan Rellie, immediately to my left, is a co-founder of Business Development Asia, DITA, founded in 1996 by Euan and his co-founder, Charlie Maynard. It's a firm that has specialized in investment in China and in the Pacific Rim. Now with ODI, overseas direct investment, coming from that area into the United States as well. Their mandate has expanded significantly in that regard as well. 4 offices in China, in Tokyo, in Bahrain, in London, as well as being headquartered here in New York. Euan and his firm, and Justine Mannering, Managing Director of BDA, who was so involved with this process as well, oversaw the investment banking aspect of 2, not 1, but 2 of the 363s we're going to be talking about here today. Michael Small is my partner at Foley and Lardner in our Chicago office. He is the leader of our bankruptcy and restructuring team. He works very closely with our agricultural and food group, as well as our sports group. I think last year, this time, Michael, we were acknowledging the transaction that you had worked on in terms of Guggenheim Partners' acquisition of the Los Angeles Dodgers. I guess there is some synergy between food and sports. There's a lot of concessions in ballparks. And being with a law firm that was founded in the Midwest 160 or 170 years ago, where we work with a lot of industrial heartland companies, but also a lot of agricultural companies. As one of my environmental partners from our Madison office said to me, we know about manure. And so Michael actually has worked in the agricultural space and was a perfect choice to work with us on this transaction as well, or the series of transactions. So AgFeed is really a prototype of what happened with the RTO, reverse takeover syndrome, as it played out in China as well. There were about 370 Chinese companies that between 2004 and 2011 went public. And they went public through the backdoor process of an RTO, where they would merge into a shell company, and then they would not have to go through the rigors of an IPO process with the SEC comments and that whole process itself. I mean, the SEC, more recently, the last few years, has kind of been clamping down on that process. Essentially, if companies now go through an RTO, they're going to file their Super 8K. They're then going to get an extensive comment letter from the SEC, giving them the same type of scrutiny that they would have gotten had they IPO'd initially in that same regard. 2000, AgFeed was founded in 1995, a nutritional feed company in China. 2006, it goes public. 2007, it lists on NASDAQ. Between 2008 and 2009, very active in the capital markets, raising approximately $100 million from institutional and high net worth investors through the issuance of securities and convertible debt. What was their purpose? Their purpose was then to diversify, not only to be a feed company, but then also to expand to become a leading or the #1 hog producer. That was their goal in China. And in the course of that process, they acquired some 29 hog production facilities over 5 provinces in China that went along with the 5 feed mills that they had as well. In 2010, they saw the opportunity to make an acquisition here in the United States of one of the top 20 hog producers, a company called M2P2. And the thought there was, I think from a strategic perspective, that by having operations here in the United States and in China, you would be able to introduce best technology and practices in China as well. Witness something that has been done far more successfully in terms of the Smithfield acquisition that has taken place, earlier this year. In 2000, that happened then in September 2010. The new management then of the company gets involved, and, well, a curious event. Mostly with these RTOs, the Chinese management is still in place. And what happens, based upon these SEC investigations or class action lawsuits, they go and they hide in the bunker. You can't find them in China. You can't access them in terms of depositions, et cetera, et cetera. Here, prior to the involvement of any of us, the management and the former owners exited through a series of sales of their shares. So essentially, AgFeed was left with a situation of trying to professionalize its management. So you have this acquisition in 2010, the management of M2P2 goes to China, and all of a sudden, they find that the realities are quite different than what had been portrayed to the public. That indeed there was, evidence of second sets of books, and that then triggered the internal investigation in 2011, a special committee. It triggered an SEC investigation, triggered as well a class action lawsuit. If that was not enough, in the midst of this, AgFeed then started having issues with its one customer, Hormel, where 95% plus of its 1.3 million pig annual production goes to Hormel. We're involved in arbitration. AgFeed loses the arbitration. Even a $8 million award is material to it, given the fact that it was really right on the cusp of different covenants. Its loan facility matures, farm credit and its syndicate bank wants out. And so we're now in a scenario where the company is being essentially forced to liquidate and to deal in a situation where it has to, at the same time, work with its whole growers network. Not only the 5 sow farms that it has spread over 3 or 4 states, but I think 240 growers in different farms, mostly in Iowa. And that's when the board essentially turned to Mackinac to kind of come into this process first as advisor, and then not only as advisor, but then Keith stepping in as the CRO of the company itself. So Keith, why don't you kind of pick up here? You come into a situation where we have disruption of management in China. We have no reliance on our books and records in China. We have issues with our creditor. We have issues with our one customer. We have a class action lawsuit pending. We have an SEC investigation going on. And here you are as advisor to this company.
Yeah, borrow Peter's term, a shitstorm. We use that term in the Midwest too. So AgFeed had all of the elements of, sort of the normal crisis distress situation. It had a management that was heavily personally and probably financially invested in a strategic direction, which, we've never challenged, the underlying strategic premise of the ability to export U.S. technology to China in terms of swine production capabilities and techniques and technologies and the like. The problem with it is do you have the capital and do you have the breadth of management and resources to execute on that strategy? And clearly, when I came into AgFeed a little over a year ago now, the capital runway had virtually been eliminated. We had one financial institution, a group of institutions, but under the Farm Credit banner, that was providing credit only to the U.S. subsidiary. And this panel is about sort of Sino-American transactions, but we have to kind of build the runway to understand what we did and what happened in China. So it starts with a little bit of the U.S. story, and that is that Farm Credit had a tremendous bias against anything to do with China. They wanted none of it. They wanted no involvement in it. They wanted none of their funds and capital being provided to the U.S. operations to in any way benefit or flow to the efforts relative to China. So that spigot got cut off. Similarly, because of the complexities of repatriating cash out of the People's Republic of China, we had no access to liquidity coming out of China to support the parent operations. So you had not a liquidity crisis, but basically no access to any liquidity. You had Hormel, our main and only customer in the U.S., shooting bullets at us. And you had the SEC enforcement and investigation activities as well as players class securities. So a shitstorm. The first thing that we did to kind of bring that process to close was embrace and sort of fall into the arms of Farm Credit Bank and rebuild that sort of trust and relationship, which allowed some of the process to allow some of the liquidity to flow into the parent to effectively fund the retention of advisors and to have the opportunity to develop solutions. That then sort of goes to what are you going to do with this business? And to maximize or to achieve and unlock the value of AgFeed, you have to have a runway to pursue a sale of the Chinese operations. And the only runway we had to develop to do that was to sell the U.S. operations. So the first thing we embarked on was the traditional, plan for a 363 sale. And that's what this case is really about. It's a tale of two different, remarkably different 363 processes. So the U.S. sale process, traditional out-of-court marketing effort, followed by the selection of a stalking horse, the entering of an APA, and then a filing of a Chapter 11 proceeding and the prosecution of a 363 sale. The issue here is that our stalking horse was a tough deal. And as soon as we signed the stalking horse bid, we proceeded to very actively cross-market against that transaction. And what that resulted in was basically us going to the market on a breakup value basis. In the U.S., we operated sow farm operations in North Carolina, Colorado, and Oklahoma. And the complexity of that system was tough to really harvest value. You had buyers who really wanted North Carolina, really wanted Oklahoma. Not so much Oklahoma, but really wanted Colorado. And so the ability to break that up and then aggregate buyers in the post-filing and post-stalking or selection 363 ultimately resulted in a very competitive, creative auction that resulted in 25% increase of value over the stalking horse. We busted the stalking horse, we went with a buyer consortium. That produced the liquidity and the runway to then pursue a sale of the China operations. And then I'll kind of stop there because that then leads into what we're going to chat about this morning.
And then your involvement even precedes that of Keith, because I think you were brought on board when the company was trying to monetize, raise capital, hopefully to stabilize itself and then to look to a further expansion in China in terms of the introduction of Western farms and techniques, in terms of the consolidation of that industry. So then you come in with one mandate, and then you find in the course of that mandate things drastically are changing. So why don't you kind of take us through a bit through that process in terms of how that evolved and your changing of thinking as an investment banker in the midst of all this.
Well, I mean, in simple terms, it was a constantly moving feast. And in the beginning, we were hired to try and find the capital, as Keith suggested, which would be needed to really export US best practices to China. Unfortunately, we never recovered from the fact that the Chinese management at AgFeed was very poor, had struggled. There just wasn't enough good quality management to get its head around the business at the time. We found interest, but it's extremely difficult, as everyone in this room knows, to raise capital or to find a strategic investment for a business which is performing so poorly. Where, first of all, it's performing poorly, and secondly, we didn't even know that we didn't really have good quality data as to how profitable or what losses the company was making. So we had the sense that there was value in this operation, both in the US and in China, that to the right owner that there should be value, but that new owner would need to bring management. And frankly, that meant that we were really, from the day we were engaged, we were clutching the straws to try to find somebody who would like to back the enlarged group. That proved impossible. What we found was that there was significant interest in both the US and Chinese operations. Separately, they had different challenges. The US had some challenges which meant that it was never going to be a wildly profitable standalone business in the US, whereas in China it could be profitable, but we simply were nowhere near to having a fully functioning business. So lots of buyer interest, but a real need from an investment banking point of view to try and put a box around the operations to understand where the value lay and to give confidence to any buyer that they knew what they would be investing in or buying.
And in the case of the U.S. operations, very auditable and intelligible and understandable. In the case of China, by virtue of the accounting irregularities that were uncovered, the company withdrawing its financial statements from 2008 forward, and the whole process of trying to recreate historical results involving the manpower, the people power of the company, outside accountants as well acting as consultant, FTI, this whole panoply of just trying to get a handle exactly on what were the historical results. So trying to actually do a sale in the context where you didn't have reliable information on a historic basis that one could rely on, let alone in terms of the management transitions, because you can well appreciate that once the fraud was uncovered, there was a wholesale effort as well to cleanse the management in China and to introduce new people. So during all of this being in flux, BDA was involved in the process of attempting to interest investors to invest either into the entire company or pieces of the company, on a discrete basis. Michael, looking at this now from your perspective, when I would then call you and say, Michael, I think we really need to be considering here either an out-of-court or an in-court solution, given what is coming down the pike here. Give us your reaction in terms of how you saw AgFeed evolving during that process.
I think the evolution of AgFeed was trying to match up the ability of a Chapter 11 process to maximize value with the way that value is actually created within the businesses themselves. And it started, at least I think, partly because of the history of the company, with maintaining discipline and governance throughout the entire process. Because as all three of you have indicated, the company needed, from the point of view of outsiders, whether it be Farm Credit or Hormel or creditors or equity, stability, credibility, and speed in coming through with this transaction. There's a tension that bankruptcy, I think, in this case really allowed to mediate between increasing credibility and maintaining speed. Because the habit, and I think it's a habit based on experience, of suspicion of processes that are moving quickly was something that had to be overcome at once. Part of that was that the team that came in from the outside, really led by Keith and with Euan's leadership on the Chinese side on the sales, that there were people in the company who had high levels of skill, established credibility with professionals quickly, and also had the ability to expand outside of what they had normally done. As bankruptcy and restructuring professionals know, that's one of the keys to success sometimes, is that all of the process and all of the form doesn't necessarily ensure that the profit's going to be maximized or monetized. Those people were identified and started continued to fill the roles that they needed to, but grew into other roles that were necessary to facilitate the professionals completing their jobs. A couple other things that were really important in this is the availability of Mandarin-speaking professionals on our own side, and not needing only to rely on local counsel or analogous local professionals in investment banking, because, and the use of face-to-face meetings, both in the United States and internationally, because when things are reduced to writing, nuance often gets lost. And because of the cultural differences between how restructuring is done in the United States, which is through a familiar and predictable set of processes where even if the people don't know each other, they can anticipate the steps that they want or need other people to take. And when they notice a difference between their expectation and what's happening, they're able to ask the right questions. In China, on the other hand, you don't have the same tradition of a predictable set of expectations. And to try and match those two up successfully was really one of the things I think that sets the case apart.
Yeah, it does. And there's a couple of, sort of, I think, things that, again, to focus specifically on China. First of all, while we've danced around it a little bit, let's just call it what it is. There was pervasive fraud in China. And the fraud went beyond, sort of, sets of books and fraudulent financial reporting. There was regulatory compliance, tax compliance, all up and down the spectrum of, how do you get your arms around what this business is. What that resulted in, and one thing I'll say about this team, we all collectively early on worked to develop a strategy, which was the harvesting and monetization of value. And then we really worked hard to execute on that strategy. And it was very specific: USA first, China second. The transaction around China, because of the regulatory and compliance issues, the trick that we had to turn was in all likelihood, almost exclusively had to be a Chinese buyer, with the ability to deal with the Chinese issues in a uniquely Chinese way. Regulatory compliance, tax compliance, social negotiations, those sorts of things, number one. And number two, we couldn't give reps and warranties, and we had to really sell stock, because you can't sell the assets in China and then be able to repatriate the cash out. So we could harvest the value, but we couldn't get the cash back into the U.S. to the benefit of our estates here. So this became early on a 363 sale of a British Virgin Islands holding company stock, with all of the hair of doing the ways of doing business and the complexities in mainland China. Wow.
Just one thing I wanted to add is that there is a tolerance for risk among Chinese investors, and maybe that's a more general point here. And again, the distressed investment community in this room understands the need to take risk and how you can make money by being willing to take risk. There is a tolerance for risk among Chinese bidders today that is very, very unique in the world, I think, and is very valuable. Was very valuable to this process. So the combination of cheap capital, feels like we've got cheap capital in the US, but US banks sure as hell aren't going to risk money on Chinese assets or Chinese businesses that they're not comfortable with, whereas the Chinese bidders were willing to take that risk.
In terms of complexity, we had to kind of translate to the Chinese potential buyers, ultimately the one that ended up being the buyer, the whole 363 process. It turns out that the ultimate buyer is a publicly traded company in China, Ningbo Tech Bank, listed on the Shenzhen Stock Exchange. There is a need to deal with CSRC, China Regulatory Securities Commission waivers. There was a need also to get a shareholder vote in China for the purpose. So we had that additional factor that needed to be worked on as well. I think, Euan, in terms of your and Justine's marketing this deal, I think you did reach out to European investors as well. But Keith, your comment that
you needed investors who were uniquely able to understand, if you don't have this particular permit or this particular license, what is the consequence of that, and how can you kind of deal with it, and from a risk assessment perspective, is this something that you can deal with? And obviously, ending up and having sold this to Chinese investors who had the comfort that they could deal within that system was something that other investors internationally were not able to get to that same level of comfort, given their lack of familiarity in the case of one particular potential investor with the process in China and not having gone through it before.
Right. And then I think then you build upon that, when we do 363 sales here in the U.S., right, we look for the stalking horse to establish what we all call the hard floor, right? You want the hard floor that sets the bidding parameters, and then you go from there. One of the things that we were clear about upon the execution of the stock purchase agreement with Ningbo Tech Bank is that there was no such thing as a hard floor in this deal, right? And we established expectations very early on that we were going to be retraded. We didn't know when it was going to come, and we didn't know how much it was going to be for, but ultimately the value in the SPA was going to go down, and we established expectations at a conservative level, so that when the first retrade came, and then the second retrade came, and then the third retrade came, we were still exceeding expectations, which within, this case has an equity committee, had an unsecured creditors committee, it had a very active U.S. trustee. So, managing and establishing those expectations so you can still drive forward with a deal to deliver the value, I think was also a very critical component of this.
Yeah, the point I would make is that Chinese bidders have capital and tolerance for risk, but certainty of close is the great concern, naturally. And not only were we worried about retrading, I think we were worried that one day they might just not show up,
right,
and close the transaction. And I think Keith and actually the rest of the team, but Keith was very important in this. We took very deliberate, cautious steps, not only to get a deposit in place, but to create an environment where it would be really difficult for Ningbo Tech Bank to back out. That was still a bit of a white knuckle ride, and I think
right,
we were all, even the more hardened members of the team, were quite scared at points that we wouldn't get to the finish line.
And that was the key here. Again, and I think gaining a bit of a reputation as a guy who likes to bust the stalking horse, right? So I'm going to be the person who's going to negotiate real hard against breakup fees and real hard for, again, the really hard floor, but the ability to allow competition into the process. Here, it was really just the opposite. We really needed to lock the stalking horse down, and we needed to put in all of the downside protections for us to what we all anticipated and ultimately came in the form of the retrade. Plus, you've got a business that's going south on you, and you've got employees who are, not necessarily taking the company's best interests to heart. We had work stoppages, we had strikes, we had theft, we had disappearing assets. I've got a whole legacy of discussions around the chops. And the disappearing chops and our inability to deliver the chops as a condition to the sale, which I won't go into it here, but if you're interested over lunch or something, we almost lost the deal because we couldn't deliver the damn chops.
Individual managers at our own company had their own agenda, which was very challenging, I think, for
right,
Keith, the CRO.
And I'll tell you, at the end of the day, right, I think what got this deal closed and done was the fact that Ningbo Tech Bank scheduled a celebratory announcement dinner with 1,500 industry executives, and we were down to the Friday before closing, and that scheduled dinner, and but for that dinner, we'd be negotiating still today. But they had face to save, and they had to host a dinner, and they had to announce the deal, and the deal had to be done, and it closed. And we took full advantage of that.
But there were other things too, right? We had a deposit. We persuaded them to move some money to Hong Kong, which was difficult for them to do, made it harder for them to take that money back afterwards. They suspended their stock trading for a period. So there were various ways that we got them to a point that it would have been really embarrassing and damaging for them to back out.
Right.
And we never had them quite negotiating against themselves, unfortunately. But at least they were 3/4 pregnant by that stage.
Right.
And looking at it from a future perspective as well. I mean, from this community, what lessons to take away from this? I mean, we've seen now a number of different instances of Chinese companies participating in bankruptcies. Now, this is the first one, actually, to our knowledge, where you have a 363 of a Chinese company buying China operations in a court sanctioned and approved and process itself. But I think I think we're seeing now that the Chinese buyers are becoming far more sophisticated. They're understanding now more the rules of the road in terms of the process here in the United States. So you can juxtapose. We all know what happened with Hawker Beechcraft, how Superior Aviation Beijing was not able to effectuate that deal, but left a $50 million deposit on the table. But that really was used to just kind of continue to fund the Hawker part of those operations during the pendency of their trying to get from signing to closing and to finish their due diligence. So you have situations like that do not work out. On the other hand, you have situations here like AgFeed or Fisker or others that really you're showing that Chinese bidders are able to act decisively, aggressively in a context. Because they see clearly if they see a strategic purpose in acquiring assets or technology or pipeline in order to further their business view as well. I think with Ningbo Tech Bank, as Keith was indicating, they saw this as being a real platform for themselves to become a leading hog producer in all of China. And I think that vision really kind of drove their strategic decision to work through some of these issues along the way. And to try to overcome them to get to a finish line with us.
Can I make a couple of general points about Chinese bidders in the US? It applies to distress, but it applies more broadly than that. So I've devoted my whole career to the coming Asian M&A boom, and guess what is here? I mean, I can officially announce it's here today. Last year was $70 billion of outbound investment by China, considerably more, for example, than the $40 billion odd that Japan invested in M&A overseas. We think of Japanese bidders being aggressive today, but China is now responsible for a huge chunk of global M&A. We just closed a deal. It was until recently 60 or 70% of those transactions were energy investments by China overseas. Suddenly we're seeing Chinese investors in every facet of business, and they have bank funding from Chinese banks in the US. We just sold an architecture firm in Texas to a Chinese state-owned enterprise, and ICBC, the Chinese bank, came in and lent $50 million at the last moment to get the deal done with very little documentation when JP Morgan was too scared to do it. So not only do we have Chinese government support for outbound investment today, we have management teams in Chinese companies who are increasingly foreign educated and confident in trying to do deals in the West. Those management teams are opportunistic and aggressive, and the kind of swagger that we haven't seen from CEOs in the US since before the downturn, Chinese CEOs are showing that kind of swagger today. So it's not just energy and power, it's media, leisure, consumer, professional services, food, across a whole range of different categories. And what that should mean, the kind of opportunism and confidence and aggression of Chinese bidders should, I think, be very reassuring for everybody in this room trying to find solutions to complicated, distressed situations, because Chinese bidders today will hold their breath and sign a check in a way that is pretty unusual in my career.
I mean, just some data to support what Euan is saying as we kind of position ourselves in terms of what is the role of China going forward. ODI, their overseas direct investment last year in 2013, was in 156 countries or regions throughout the world, investing in 5,090 different enterprises. Totaled $90.17 billion, a 16.8% increase over 2012. Looking to the United States, and this is kind of an interesting phenomenon because it supports what Euan is saying, that we're beyond then that initial wave of just energy-related acquisitions in North America. So for example, what you're finding more and more is private enterprises, SMEs, small and medium-sized enterprises, investing in the United States. So SMEs, private firms, accounted for 76% of the ODI into the United States last year, covering 90% of the relevant projects. Now, people are talking about the slowdown in growth in China. Yes, and if it grows at 7% this year, it's going to be the lowest in 30 years. But Jim O'Neill, who of the Goldman Sachs Group, who in 2005 coined the BRICS term, his studies indicate that even at a 7% growth, they will be contributing $1 trillion to global GDP in each of the next 10 years, which is the equivalent of fashioning a new Japan or Germany. So the amount of foreign investment that is going to be coming not only from China, but from Japan and Asia into the United States is going to be enormous. And I think to the credit of this administration and the Department of Commerce with Secretary Pritzker, that Select USA initiative is going full force, whether it's in India or China. And Gary Locke, one of his, what he regards, I think, probably as his greatest achievement, or one of them as ambassador to China, was bringing down the visa process to 3 days, because Chinese and others will complain that besides legal complexities and the cultural differences, we can't get our visas. So that whole process now has been streamlined as well. So I think, yes, CFIUS obviously has a huge role to play in this process in terms of guarding national security. Smithfield stands for the proposition that it's going to be national security, not necessarily as an impediment to acquiring a company that is, that is iconic in terms of its identification and its position in the U.S. market. But I think all of us here in this room will be seeing a significant increase, a geometric increase in the amount of joint ventures and investments by China and Asian buyers here in the United States.
And I think, Selig, going along with that, if you think about in the distress space, you're either dealing with a situation with an idea that turned out not to be good, or an idea that was good but originally attracted great idea money. And when you have that kind of capital coming to search, think about what, as a broader experience, is the United States great at day in and day out, and that's branding. So when you have companies coming over looking to make an investment, I think one of the areas we're going to see a lot of activity in is a particular brand that still has, and this actually is reminiscent of one of the hypotheticals from the last panel, you have a brand that not only has cachet, but is associated with the way that that brand generates value. So it's not merely a name, it's not like a trophy building from the old days of real estate acquisition by foreign investors. The brand itself is intimately connected to the way to generate value in the future, and I think that's one thing to keep an eye on.
I think we have an opportunity for a few questions if there are particular items that the audience wants to discuss. Keith, any closing comments then?
Well, I think you got to put the bow around it, right? Right. So the strategy was harvest value in the U.S., create the liquidity in the runway to unlock the value in China, and then whack it up. So we're in the whack it up stage now. Through the efforts of the monetization, it'll be a 100-cent case to all the creditors, and that's good news, because most of our creditors are. I don't know if many of them are in the room today. Some of them are on the panel with me, but they're mostly the professional service firms that served the company prior to the petition date, right? So, but it'll be a 100-cent case to the creditors. There is a significant equity recovery, but we've got this interesting sort of thing going on now, which is whacking up the equity. So we have three parts of the equity pie. We have a plaintiff's class action piece of the pie, we have an SEC enforcement piece of the pie, and we have traditional shareholder equity holders. That's the process we're in now, and I never foresaw that we would be at this stage of the deal, because I didn't think this would be the problem we would have. But that's what we're heavily engaged in now, and hopefully we will wrap that part of the process up quickly before we disgorge a lot of value.
And all of this is played out in a relatively short period of time. Yes, the filing of the bankruptcy was only in July of 2013, But then again, we had our stalking horse agreement in place at the time of filing as well. So that, that kind of jump-started this process. But a huge amount of effort leading up to that, and then going forward from July with the one sale in September of the U.S. operations, the other in December of the China operations. Question over here.
Yeah. Are there any particular concerns or issues related to China, like with the Smithfield acquisition? I believe that's still being approved because of national security.
Oh, no. CFIUS, closed, done. Okay. Closing dinner, the whole. I'm sure they serve pork at the closing dinner. No, done.
Are there special concerns, though?
Yeah, I think there are a lot of perceived concerns, and many of those are political. And when there's an election cycle, national politicians of both parties in this country have often pointed out to the Chinese bogeyman, and it's something that resonates. The potential for job losses in the U.S. So Chinese bidders are smart to this now. They know that one of the things they can do is say, we will keep employment and increase employment in the company that we're buying. And that's so that there's a weird situation now, which is local politicians in the US almost universally love the idea of Chinese investors coming in and investing in their town or their state. National politicians are still scared of Chinese investors and still don't make the process easier. CFIUS is a little bit, frankly, to my view, imponderable and difficult. And again, we're still at the point where if you're an investment banker selling a business in the US, you've got two bids, one which is $90 million from a US bidder that and the other's $110 million from the Chinese bidder. You'll probably take the 90 just because you're confident that you can close it. But increasingly, the bidding interest of those Chinese bidders will not only mean that they win sometimes, but it might even push the 90 up higher. So the Chinese are becoming more confident in closing.
But your question raises a good planning feature, and we saw it in Hawker Beechcraft, or we saw it in A123 in that sale. In Hawker, even though it didn't result in the sale of the entire company itself, the company has spent about a year before the chapter in terms of segregating the military applications of their operations from the domestic ones. Similarly with A123, in terms of that acquisition, it was a small component, but the military battery applications were then spun off to, I think, a Tennessee-based company. One will need to kind of plan this so that from a patent perspective, from a firewall perspective, to the extent that there is sensitive technology that could influence a CFIUS decision, that the planning goes into the monetization of this. But I think Smithfield was important. Yes, people wanted to rephrase the issue as food security, et cetera, but ultimately, and Treasury Secretary Liu at the Select USA meeting in Washington, D.C. said, CFIUS is about national security. I think there's a firm commitment here that if there are transactions that don't involve national security, that they are going to be, that CFIUS will not be the impediment, or shouldn't be the impediment to the realization of those transactions.
Selig, I've got a question for both you and Euan, and I hope we've made this distinction. It's a tale of two worlds, right? There's the outbound investment out of China into the U.S. and buying U.S. assets. That was Smithfield. Then there's the M&A activity in mainland China. There is still, as we encountered in this transaction, a huge bias in this country to owning assets in mainland China because of regulatory concerns and compliance concerns and the fraud concerns. I can't tell you how many times I had to answer the question, how do you know you have any farms in China at all? How do you know they even exist, right? So I guess my question is, because you all are really active on the ground in China, where do you see the horizon around regulatory compliance and the transactional sort of infrastructure to give outbound investment from the U.S. into mainland China some levels of comfort?
Well, on a number of scores, I think ODI, investment outside of China, in 2015 or 16 is going to equal FDI, investment into China. That FDI though still has to come into China because in terms of knowledge-based and other services, healthcare, for example, they're confronting a terrible crisis in terms of the aging of their population and how do you take care of them. I think what you're seeing is a movement towards transparency in China. What did China do with its public offerings? It suspended it for a year. The CSRC, essentially there were no public offerings. And then, because what are they trying to do now? They're trying to get to a process-based system like we have here in the United States. Let the market govern what deals go out. Let it govern how those are priced. Contrast that with what has been the system up to now, where companies would be in the queue for 3, 4, 5 years, never knowing when they're going out, because the decision as to when you would go public would be one that would be made politically on a relationship basis, based upon the CSRC, based upon the province, based upon the municipality, based upon all these different factors. So they're trying to get more to a market-driven economy. The only way they can get there is through transparency. And I think there's an attempt now to really try to introduce more and more of best practices and standards. At the same time, there are some sacred cows along the way in terms of fiefdoms and vested interests, which benefit from having a discretionary as opposed to a process-driven environment. But I think China understands if they want to sustain growth and they want to move up on the value chain, as they have to, because they are no longer the lowest price manufacturer in the world. You want to have your lower price manufacturing? Go to Mexico, go to Indonesia, go to Vietnam. They have to adopt standards that are more transparent and are more and provide a level of comfort from an international community investment perspective.
So, some of it's consumer driven. The Chinese consumer is rearing his head. They're very there's great interest in investing in consumer and luxury space now, which is a big part of our business. One of the odd things we've seen is we're in a very interconnected world already, and we've seen about 3 transactions. We've closed 1. We're working on 2 in the last year, which are quasi-distressed U.S. situations where there's real value in the Chinese asset, and sometimes in a distressed situation in the U.S. now, counterintuitively, the solution is to sell the crown jewels in China and realize value that way. And what I would say is there's a huge amount of private, a bit like there is here today, there's a huge amount of private equity, there's a wall of private equity money chasing deal flow in China today. 7% GDP still looks pretty attractive compared to most parts in the world, and there's going to be a very robust domestic M&A market in China for the coming years, not only outbound.
Please.
What's the typical premium that they're paying now, and are those Chinese buyers, what's the typical premium that they're paying now for outbound transactions? Do you expect,
compared to what a U.S. buyer would have to pay for the same asset? 20 to 30%.
and do you expect that to compress in future years, and how quickly will that compress, and are those buyers sort of preconditioned to the fact that they need to pay up?
They recognize now that they have to jump through hoops to have a chance of closing, and that's not only paying more is the simplest answer, but also making commitments to future employment and investment and IP protection and a range of other things. Yes, it should compress, but it's not about to compress immediately. It'll take time, right? So we should all be using that to our advantage. I said in every process, the Chinese buyer may not win, but the Chinese buyer is going to bring competitive tension that can drive better outcomes for any sale process.
Are they to be perceived as dumb money in any of these transactions?
Sometimes, but getting smarter. Variety, right? It's street smart as opposed to polished.
Well, and it's a longer term view, right? I think their investment horizon is much longer than what you will typically find here in the U.S., particularly in private equity.
But they're terribly concerned of not replicating the Japanese experience of just really buying at the high, and then finding yourself with with troubled assets and a capital structure as a result of it. Their biggest need right now is for the depth of senior business and managerial talent.
Right.
They and those that are cross-disciplinary, culturally able to function in both. There's they're coming to this acquisition game as a note late in the process, and to gear up. They are finding the need. Of more time and effort has to be made to train, the next generation of individuals who will be able to be leaders on a cross-border basis.
Biggest problem China has today, in my view, apart from pollution domestically, which is a huge problem. Chinese people, when they get rich, they want to leave China, and they want to educate their kids here. They want to come and live here, or in Canada or Australia, and that's a real challenge for China. But again, it's great for people selling assets in this country.
Please.
In the context of inbound Chinese investment to distressed deals in the United States, we usually have two kinds of distressed deals at least. One is where you have a good company but a distressed balance sheet. The other is where you really have a distressed company that has both balance sheet problems as well as management issues. What is the confidence in terms of Chinese investors who would otherwise be interested in opportunities in the United States for coming into a U.S. turnaround operation as opposed to simply an over-leveraged one?
Well, they have done. They're nervous, I would say, but they will only do it if they have qualified management. Then no Chinese guy is going to buy a business here and think he's going to manage it himself. So there has to be a CEO in place, or you have to find a CEO. Otherwise, they're not going to.
And you have to pitch it that way. So, if you're running a competitive process, you have to recognize that that's part of the issue, and they're going to want that as an element. So you structure your process to deal with that. But I agree. They're not going to come in and run a distressed turnaround situation.
Thank you all. Glad we had this opportunity to have this dialogue with you. Thanks again.
Thanks.